Alright, the last category of ratios here refers to the company's market value compared to various financial statement data. So in these last two ratios, we've got the price earnings ratio and we've got the market to book ratio. In both cases, the numerator is the same. Okay, in both cases, the numerator is the market price of the stock, $12.17. That figure is actually given in the data section next to the income statement, other data, 1217. However, it doesn't necessarily have to be. It's easy to find a stock's market price. All you've really got to do is go online, enter its ticker symbol at any of numerous financial websites, and you can get the up to the minute price at which those shares are trading. Okay, so you can take that price and compare it to information that is on the financial statements. In the price earnings ratio, the PE ratio, you are comparing the price of the stock per share to earnings per share. Now everybody should know what earnings per share are. Let's take a look at that just in case, okay, just as a review. Earnings are your net income. Okay, looking here at net income, I see that that's $253,584. If I divide that by the number of shares outstanding in that year, 250,000, then I get earnings per share, which is approximately $1.01. So this would be your profits divvied up amongst the shareholders. So you could look at it this way. If the company's net income is $253,584 and I own just one share out of 250,000, then how much of this figure, how much of this is, quote, mine, so to speak? How much of that belongs to me? And you could think of it as $1.01 out of all that profit is yours. Okay, so if that's true, then we can say that this year the company is earning $1.01 per share, but investors are currently willing to pay $12.17 for the stock. Alright, so what ratio is that? What comparison is that? Okay, well, $12.17 compared to $1.01 per share, that is a ratio of 12. So for every dollar of earnings that the company is generating, investors seem to be willing to pay $12 right now for the stock. And that could mean any number of different things. Alright, let's also look at market to book briefly. Market to book also looks at the market value of the stock, $12.17, but it also looks at the book value of the company's equity. And it does so on a per share basis, right? And that makes sense because the market price is stated per share here. So the book value definitely needs to be stated as a per share thing. Okay, so how do we find book value per share? Okay, well, we're looking at the company's equity, and we see that in the market, that equity seems to be worth $12.17 per share. That's what people are willing to pay for it. But on the books, how much should the equity theoretically be worth anyway? We know that in actuality, it's almost never going to be the same amount. But on the books, what does shareholders' equity look like? Alright, well, shareholders' equity, total equity anyway, we see that that's 1.95 million. So we could go back here and we could take that number. In fact, we could get our calculator and say 1,952,352 and divide that by the 250,000 shares. Okay, so there we go. And so theoretically, if this is what all the equity in the firm is worth, and we divide that amongst the 250,000 shares, then the book value per share should be $7.81 approximately. $7.81. So now if you take that $12.17, that's the market price of a share, $12.17, and divide by the $7.81 per share that theoretically it should be worth on the books, then you get a ratio of about 1.56, a little over 1.5. So this tells us, this market to book ratio tells us that investors are actually willing to pay about 1.5, 1.6 times what the books say that the equity should be worth. In reality, that's to be expected. Things on the books get recorded at historical cost. Over time, market values change. They often go up, and so very often your market to book ratio really is over 1. Your price earnings ratio also should be considerably more than 1. As for what exact ratio is right, you don't know. Okay? Thinking about the price to earnings ratio, you've got, on the one hand, you've got the price that investors feel is fair for one share of the stock right now, and on the other hand, you've got the earnings the company generated in just this year. Obviously, if you're an investor, you're willing to pay more than just this year's earnings. You're typically going to be willing to pay much more than that, because when you buy the stock, you're buying not just what the company generates this year, but in all future years. So if you're willing to pay a high price, despite the fact that there might not be very much in earnings today, that could just mean that you're optimistic that in the future it will be generating even more earnings. Or let's say you're willing to pay only a very low price compared to the earnings today. That could mean that you're not expecting very much growth in earnings down the line. So there are different interpretations for this. DeLeon was below average, and actually they're still below average on both of these. I can't tell you conclusively whether it's good or bad that the PE ratio and the market to book ratio are above or below average. That's just up for debate, really. Because when ratios like the PE ratio, when they are higher, that could indicate, like we said earlier, that could indicate that expected future growth is higher. It could just mean that, earnings might not be very much right now, but investors are rightly optimistic that things are going to be much better, earnings are going to be higher in the future, and that's why they're willing to pay a higher price even now, because they're anticipating higher future earnings. So high PE ratios could easily be an indication of high expected future growth. However, a lot of investors look at it from a different angle. Some investors look at this and say, well, if the PE ratio is high, it could be that the price part of it, the numerator, is just too high relative to earnings. It could just mean that the stock is plain old overvalued. And there are a number of investors who think that way. They look at things like the PE ratio, the thinking being that they ought to fall within a certain range, and if you get too much above that range, then it suggests that the price has gotten out of line compared to the earnings per share. If that's the case, and you really believe that the stock is overvalued, then you would stay away from it. You wouldn't want to invest in those shares. On the other hand, we talked here about what higher ratios would mean. So by extension, what do you think lower PE ratios would mean? Well, turn the argument around. One thing that it could mean is that the price part of it is just too low, and in fact that the stock is cheap relative to what it should be. It could mean that the stock is producing a certain level of earnings, and right now the stock is kind of on sale, so to speak. If that's the case, it's undervalued, then that would be a stock you would probably want to snap up. That being said, there's another interpretation too. Alright, a low PE ratio might not mean the stock is undervalued. It could, but it might not. It might also just mean that these earnings aren't expected to grow that much in the near future, and so investors just aren't that excited about the stock at this point, and rightly so. Exactly which interpretation is correct in any given situation, that's for you to determine. Okay? You have to do a little bit more digging and learn about the company to be able to make that call.